Good morning. Today is the 20th of February 2015, and we're well into the new year. Can't believe the time's passed so quickly. I just wanted to take you through a quick look at some of the stocks and the markets in general. I'm starting off here with the NASDAQ Composite Index. You can see here this line here is the end of the year, which ended in a decline into the beginning of January. And then we had all this choppy trend here. And then I'm pleased to say 6 trading days ago, we started to break out to the upside through this resistance level. So that's good news for the market. I wouldn't be surprised to see the market correct back a bit, but as long as we stay above this trend line, which is 4,800, then an uptrend is intact. And certainly after the negative effect of oil last year, and I'll just quickly show you the oil chart. This is oil. This decline from July to September was generally thought of as good in the market because that just made things a little bit cheaper, but then there was concern when the market declined even further here, and then the decline started to really accelerate to the downside. I mean, this is a very significant downward move, as you can see, then some slight pause, and then we continued. So overall, the world, I believe, got concerned that along with oil, commodity prices were dropping, gold was dropping, silver was dropping, we could be headed into a deflationary period. In every crisis point, there is an opportunity, and the opportunity here was in Europe. I believe the governments got concerned also about deflation, and especially Germany, whose historical past makes them very concerned about inflation. Because I'm not sure if you know this, but they had hyperinflation just after the war, and people actually got paid daily, if not 2 or 3 times per day, because inflation was so bad. A loaf of bread, for example, could go up 10 or 20% in a day, the price of that loaf of bread. So that's etched in the historic memory of Germany. So they're really concerned. But now they can see that there's more likelihood of deflation than inflation, so they've agreed to do quantitative easing, and many believe that will be supported over the market. And my own view is this low oil price, and we've now recovered slightly, is overdone to the downside, and that we will see some further increase. This, by the way, is the United States Oil Fund, because I haven't put oil price up because I can't invest in the oil price, but I could invest in the fund. But it replicates the movement of the price of oil. So I believe if this recovers slightly, and we've got the quantitative easing, this will be a good supporting wind for the market. And as long as we're stable, we will see the stocks that are in the Insiders Club start to outperform. And here's an example of some of these stocks. There's Celogen, which is a biotech company, a very big biotech company. This was the start of the year where this plus sign is 110, and it's in the 120 region right now. That's not a bad move. That's about 9%. Facebook, I've been very patient with. It's been in a sideways range since August of last year, but you have to understand markets don't go up in a straight line. In fact, they spend more of the time going sideways or even down than they do up. When they go up, the moves really can show significant returns. So if I went back to December 2013, this shows you here significant move in Facebook, profit taking down to here and consolidation. When all the profit takers, this is the weak holders of the stock, are out, off to a new high. And then we have from that high to this low is somewhere in the region of 22%, which is why we exit when our stop losses are broken. Now, why is it 22%, or it could be 25%, it could even be 50%, but it's 22%, and that's because the move from here to here is somewhere in the region of 80% movement upwards in 3.5 months. And what happens is when you get such a huge gain, 80-something% in 3 or 4 months, when profit taking sets in, a lot of people decide to take profit. It's the underlying psychology of investors that the more something goes up, the more people take profits when the psychology kicks in to take the profits. But the overall direction of that stock, if the fundamentals are good, and in the Insiders Club, we're looking at undervalued stocks with superior earnings growth, or rather we're looking for superior earnings growth stocks, and then we look at the undervaluation, the P ratio, the price that you pay for that stock against the growth. And then when this correction ended, off we went. So we went from, you can't buy in at a low, but it went from 55 to 80, which is somewhere in the region of, quick bit of maths here, is over a 50% gain. And then we've gone sideways, sideways for 1, 2, 3, 4, 5, 6, 7 months. And then last night, we had this significant update, 3.53%, which is great. And if we break out above 80, we should see Facebook start to do what I told people it would do for some time, which is propel upwards. Here's Apple. And again, you can see here, we have these big sideways movements. Here, this is over 5 months. Well, we've got right back to here. We've got over 6 months of sideways movement, a correction here of about 10%, and then off we went to the races. Then a correction here, significant correction from 120 to 105, which is 15% in a month. That's quite a lot. And then we broke out again to the upside, and we're at new highs. And I still think there's a lot of good things in store for Apple. So, just checking what happened here. Okay, we're 7 minutes into the talk. I don't want to overdo it because I appreciate people have things to do. This is one of our great stocks we've had for some time, Skyworks Solutions. Again, we can get consolidation phases. I just wanted to show here what happens with stop losses. So the stock's moving up nicely, corrects back, moves up, corrects back, and then this plateau here, where that top is roughly the stop loss point. We then break out above these highs, correct back. This is the stop loss point. Then we break to new highs here, correct back, and here's the stop loss point. It's not a fixed percentage because, as I showed you earlier on, the more the market moves up, the more it's likely to correct. So here, this has gone from 70 to 82, and then it corrected back to 78 from 82, which is about 5%. But that's where our stop loss level is now, and the market's looking good. So overall, I just want to say that I thought the end of last year would see significant upward movement in the Insiders Club portfolios of buys and sells that people follow. However, that didn't happen because of the collapse in oil prices. But I'm really looking forward to a very good year this year, because based on historics, we should return to our mean performance. And if a stock's earnings growth is growing 20 to 30% per annum, then logic tells me that the stock should rise 20 to 30% per annum. And if the stock is undervalued, then there's even more opportunity. So again, I keep reiterating it to people, but I've got to say it because I'm going to tell you in the future, I told you so. If you're not in the Insiders Club, this is a great time to join. If you've got other portfolios, I do look at 46 world stock markets for my other services. I can direct you on where you should be holding and folding. And if you have funds, so you're in mutual funds, unit trust funds, insurance-linked funds, or exchange-traded funds in portfolios, you can also send me those, ceo@richmondth.com, and I'll be happy to tell you where the trends are and which trends look good, which trends don't. and where I think the better trends are. So on the 20th of February 2015, this is Graham Bibby signing off, saying have a great weekend ahead. Bye-bye for now.